Hello. First of all, we'd like to thank our professor, Dan Friedman, for guiding us through this process. This paper was the result of our project in our market design course at UCSC. So the focus of this paper is solely on-chain decentralized exchanges, which we'll refer to from now on as DEXs. And we're not focusing on centralized or hybrid approaches, which have their own trade-offs. So in a fully on-chain DEX, all of the incoming orders from traders are sent publicly to an on-chain smart contract that will perform the matching and executions. In practice, many of these deployed DEX designs are modeled after existing market designs like continuous double auctions, which we'll discuss in a few slides. And in this setting, orders are matched in the order that they arrive to the exchange. We will see that the order that a trader's order is processed within a block can be the difference between completing a transaction and failing to do so. So just a quick overview, we're going to talk about the motivations for this work and then discuss the different order types that we're considering and how they will be used in different market formats. We tested this in a simulation and we'll be discussing how that simulation was ran. So for our motivations, so each trader's order will update the state of the exchange depending on the order that it was placed in the block. And so the ordering of messages within a block is completely determined by the miner and is independent of the times that they were submitted to the mempool. And so since a rational miner is trying to maximize the money made by including an order, they will prioritize orders from the mempool with higher gas fees. The result of this is that a better priced order that arrived to the mempool first may be processed in the next block after an order that happened to arrive at a later time, but with a higher gas fee. So if one wants to ensure that their order is processed first, they'll have to hike up their gas fee, and this results in an arms race of gas. So this leads to some interesting front-running scenarios that make for a horrible trading experience. Since everything in the mempool is public, a front-runner can spot a favorable potential transaction in the mempool and duplicate the order and choose to submit their own copy to the mempool. If they submit a higher gas price, the order is more likely to be processed first by the miner, and they'll succeed in front-running the transaction. This results in a mistrade by the honest trader and a lost gas fee that they won't be able to recover. So this was an example of a trade collision. There's similar attacks by front runners like cancel collisions, and these can all be exploited because of two properties. Like first, orders are public, and second, these transactions are determined based on when the orders are processed in the block. So in our paper, we're going to discuss different order types and how different market designs can reduce the impact of these front runners. Also, as a side note, within the past few weeks, a company recently launched a DEX that utilized one of the techniques we discussed called batch auctions.
So now I will introduce the order types we use in our project. First, let's start with the standard limit orders, which are defined as messages with three parameters: a buy-sell indicator, a quantity Qmax, and a limit price P. So big Q T0T denote the cumulative quantity executed during the time interval T0 to T, which is in the following functional form. If the minimum market price P min is above the limit price P, nothing is bought. If it is below the limit price, the order is fully executed, so QT0T equals to Qmax. If it exactly equals the limit price, then the quantity executed depends on the rule of allocating traded quantities when it may not be possible to satisfy all demands. This allocation rule determines alpha T0T, which is a monotonically non-decreasing step function of time measuring the fraction of the order executed up to time T. So we're going to skip this graph, and Jason is going to show a animation of it. Next, let's move on to continuous scaled limit orders. The continuous scale limit orders are defined as messages with 5 parameters: a buy-sell indicator, a quantity Qmax, 2 price levels P low and P high, and the max trading speed Umax. The trading speed of below demand, UPT, is a function of the market clearing price PT given by the following functional form. It says if the price is strictly below PL, the trader buys at the rate Umax. If the price is strictly above P high, the trader trades 0 shares. If the price is between P low and P high, the demand schedule is interpolated linearly, making its slope Umax over P high minus P low. Thus, the cumulative quantity executed by time T is QT0 to T as an integral of UPT. So let's denote DP as the aggregate demand schedule and SP as the aggregate supply schedule. We have the excess demand and at the best bid and excess supply at the best ask. And let's define the relative order imbalance omega in domain 0 to 1 by excess demand at best bid over the sum of excess demand at best bid and excess supply at best ask. Then we can find the market clearing price PT uniquely defined by this functional form as a weighted average of PB and PA. Again, I will skip over this slide, and Jason is going to talk about the animation here.
Okay, so this is an animation to help demonstrate the differences between standard limit orders and continuous scaled limit orders. The dark colored bars are for continuous scaled limit orders and the light colored are for standard limit orders. Before the visualization begins, there are 3 bids and 3 asks that are more easily understood on the right graph showing the standard limit orders. Notice the green line on the left-hand side is for showing the uniform clearing price and trade volume in shares over time of the continuous standard limit orders. When the send ask button is pressed, the trade immediately executes in the standard limit order environment. But as shown, so on the left-hand side for the continuous standard limit orders, we see these more gradually sloping orders. And the nickname for continuous scaled limit orders is flow orders because trade inventory slowly flows between traders. And for curious readers that would like another example, please see the website at the bottom and you can play around with this yourself.
So now I will introduce the market formats used in our projects, which are continuous double auctions and frequent batch auctions. So continuous double auctions are one of the most common forms of marketplaces and has emerged as a dominant financial institution for trading securities and financial instruments, as they provide a dynamic and efficient approach to the decentralized allocation of scarce resources. In the CDA, bids and asks may be submitted at any time during the trading period. If at any time there are open bids and asks that match or are compatible in terms of prices and requirements, a transaction is executed immediately. In this auction, orders are ranked from the highest to the lowest to generate demand and supply profiles. From the profiles, the maximum quantity exchanges can be determined by matching asks with demand bid. The frequent batch auctions is proposed to eliminate the risk of latency arbitrage from continuous time auctions. And by having batch auctions with some high frequency, say once every 100 milliseconds, the market would establish an equilibrium price that matches supply and demand, minimizing the proportion of unfilled buy and sell orders. Frequent batch auctions use a standard limit order book, and they do not eliminate the need for an allocation rule like time priority or pro rata order matching. Since the market clears in increments of blocks, there will be typically excess supply and demand at the market clearing price. Thus, frequent batch auctions require an allocation rule for determining which executable orders do not get executed at the market clearing price. 2 possibilities include the gas fee priority and also the time priority.
So now we'll discuss how CDA markets would operate in a blockchain environment. So to simplify things, let's imagine that the only transactions in this network are trading orders to update the state of a DEX smart contract. So as traders send their orders, they will arrive to the mempool before being mined into a block. These orders will update the state of the exchange depending on the order that they are executed within the block. And so because this ordering is determined by the miner, and a rational miner is trying to maximize the money made by including orders, they're going to prioritize orders with a higher gas fee. The result of this is that better priced orders might not necessarily be executed first, even if they arrive to the mempool first. Instead, orders with higher gas fees receive priority. And so the difference in a frequent batch auction market format in the decentralized setting is that the ordering that these player or trader orders are executed in doesn't affect the outcome. So the idea is that an auction will be at the end of the block after every order has been processed. And when this auction occurs, um, the orders are then sorted by their price. So instead of the ordering within the block mattering, instead what matters is how competitive their price is. So this lessens the impact that gas plays. All that's required now is the minimum gas to make it into the next block. And from there, pricing affects whether the transaction goes through. And so continuous scaled limit orders would operate just as in a frequent batch auction setting. So it'll receive the same benefits that batch auctions provide. However, because continuous scaled limit orders are defined as these piecewise linear trading functions, they're more reactive to changes in price. And so if the price of the asset changes, and in a traditional CDA setting, you would need to cancel your order and re-update your price. Here, your order is flexible enough that it can account for these changes in price, meaning that a single order can trade in multiple batches without needing to reprice, which saves the trader gas money from having to resubmit orders. And so now we're going to talk about a high-level overview of the simulation environment. So from this picture, at the top, there are these two, this bid and ask price distributions that investors will draw from to price their orders. So as a note, bid represents, bids are the same as buy orders and asks are the same as sell orders. On the left-hand side, there are market makers, which are traders that will place prices based on prices that they've already seen in the mempool. And the miner will periodically produce a frame from the mempool orders and attempt to front run orders. After some delay that simulates the mining process, they will produce a block, and then orders are going to be processed sequentially in the block, and the state of the exchange is updated according to the market type we are evaluating. So as shown before, we have three types of players. The fundamental value is what the real price of the asset being traded is. This is not known to any player, but is derived from the price distributions that the investors are basing their orders from. One important thing to note is the mempool and the order books are public, and so they are observable to all the players and will be used by the makers and the miner to price their orders. So there are a certain number of investors in the simulation. They will randomly choose a price and place an order, and they will also randomly choose a gas fee and a trade volume. So in our case, there is a single miner. So the miner will wait a random delay after the block publication to form their next frame. This delay captures the latency from propagation delays in a peer-to-peer network and allows us to simulate with only a single miner while capturing the behavior of there being multiple. And it is the worst case scenario that the miner is the one front running, as they can, with 100% guarantee that they front run any other player trying to front run, because they are the ones determining the ordering of messages within a block. So the miner forms a frame and keeps this frame hidden from other players. They are going to, with some constant probability, enter a front run order, a profitable front run order to the top of this frame. And then after a delay that's meant to capture the mining process, the block will be published, and each order is going to be processed in decreasing gas order and will change the state of the order book. And so one thing to note is that the miner's front run order does not need a gas fee, and it will always be published first or processed first because they publish the block. And the maker, so there are three behavioral types of the makers that will influence how they price their orders. Each maker will infer what they think the fundamental value is based on prices they've already seen. Their goal is to exploit arbitrage opportunities that arise when prices in the order book they differ from their inferred price. And makers should hold as little inventory as possible. So to incentivize this, a tax is applied after each block based on their current inventories. At the end of the simulation, liquidation occurs, and all makers with negative inventory must balance their books by purchasing that amount at the fundamental value. And those with positive inventory must sell at the fundamental value. And for this simulation, we use three performance metrics. So volatility of price tells us how much transactions differed from each other. We also measured how much these prices deviated from the fundamental value of the asset. And finally, the social welfare cost tells us the cost to society that miners and makers imposed through arbitrage and front running.
So now I'm going to present the preliminary results we got from the simulation. So the first table is obtained from the simulation by varying maker spread. From panel A to panel G, the maker space is increased from from 1 to 4 in increments of 0.5. So we have the consistent result that CaliFlow market using continuous scale limit orders give the least price volatility, the least pricing deviation from fundamental value, and also the least welfare cost compared to frequent batch auctions and continuous double auctions. By comparison, CDA has the worst performance, partly because there is a time priority involved. One point worth noting is the social welfare cost. For continuous scaled limit orders, the welfare cost doesn't differ a lot whether taking the liquidation into account or not, and it is relatively lower when there is no liquidation. On the contrary, for FBA or CDA, the social welfare is very positively affected when the liquidation is taken into consideration. This huge difference is largely due to the cut in makers' profits and the raise in investors' profits when liquidation is mandated, as is shown in the raw data. From panel A to panel G, when we do the comparison among panels, we can see when makers are least aggressive, that is with the greatest maker spread, there is the least pricing deviation from the fundamental value, although the price volatility varies. Here's the result from the simulation by varying minor front-running probability. From panel A to panel E, the minor's front-running probability increases from 0 to 1 in increments of 0.25. For each panel, CaliFlow market always results in the least price volatility, the least pricing deviation from the fundamental value, and also the least welfare cost. Additionally, CDA has a quarter more of the volatility of prices and pricing deviation than the FBA. The liquidation only has an impact on the social welfare cost, which results in a greater cost when taken into account for flow orders, whereas a much lower welfare cost for FBA and CDA. The similar reasons as the above also apply here. As we increase miners' probability of front running from top to bottom, we observe an increasing trend in price volatility and root mean standard deviation. So in conclusion, we find that CaliFlow market provides the least price volatility, the least pricing deviation from fundamental value, and also the least welfare cost when compared to CDA and FBA markets with a uniform price. When market makers are less aggressive submitting their bid-ask pairs, it decreases the volatility of price as well as the pricing deviations. From the miner's perspective, the greater probability of front-running results in a more volatile price and greater price deviation from the fundamental value. As for the future work, we are considering including smarter miner and maker strategies and potentially endogenous investors. We also wish to investigate how modifications to the simulation parameters and player strategies affects the market's outcome.